Hey all, and welcome back to Money Managers, a User's Guide. I'm Nathan Peters. So the rain is still falling, and northern and western Sydney especially are having some horrible flooding. So we're very lucky to be on high ground and able to get around, but unfortunately there is no suitable backdrop for you, my valued viewers. So we'll have to deal with virtual environments for now and hope for better weather. This is a quick roundup episode that I did more for my own edification, but I think would be helpful for anyone who is curious how the Aussie asset management industry is doing generally. In summary, I ran a quick data dump and sorted through all the listed mutual funds and closed-ended funds available on the Australian Stock Exchange. I've sorted for reasonable assets under management of over 50 million in Aussie dollars, and more than 5% of active risk over and above the other typical factor risks we use to evaluate funds with using Ven's statistical software, which you see here. So these are all active alpha-seeking managers, regardless of their specific mandates, which can vary widely, and although priced daily, can include illiquid assets. I then weighted the remaining 54 funds by their current AUM to get a sense of the market's real opportunity set, found proxies for those funds with less than 3-year track records, and rebalanced the weights quarterly. So what I found was astounding and makes me excited to be in Australia amongst the investment professionals here. In the main, despite some notable exceptions like Magellan, which have been well covered in the press, most of the listed active managers add significant uncorrelated alpha over their benchmarks over the last 3 years. This flies in direct opposition to accepted wisdom that active managers don't add value after fees. And granted, we've had tremendously fast markets over the last 3 years, including pandemics and now wars, but you can certainly say that when volatility is present, the professionals maybe aren't the group of mugs that the bogleheads make them out to be. So let's dig into this a little. Over the last 3 years, to the 28th of February, listed active managers in Australia running over $55 billion in Aussie dollars in capital have matched the MSCI World Equity Index in sharp terms, but with lower volatility and returns. In fact, the factor footprint of Aussie listed active managers, while noting the obvious FX risk versus dollar assets, which is what the Venn factor framework is native to, is about 0.8 to equity, 0.5 beta to FX carry, 0.2 beta to emerging markets, 0.1 beta to low risk stocks, and negative 0.2 to US inflation. So in total risk terms, that's about 2/3 equity risk, with the second largest risk being, other than FX, of course, being their active bets, security selection or asset timing, at about 1/10 of total risk. If we look through to the individual funds, this active risk varies widely, with WAM taking on the most active risk at over 80% in the case of its strategic value fund, and bigger names like Magellan, Fidelity, and Vanguard taking mid-teens active risk. But what about the productivity of this active risk taking? Who's really adding value? Well, even at an aggregate level, the Aussie listed fund management industry added over 6% of alpha over the last 3 years, which is a tremendous result. If we dig in a little more, large funds like AFIC and Argo have contributed most to this result, and no surprise, a large struggling fund like Magellan has detracted the most alpha. But if we sort by the most to least absolute alpha, not taking size into account, we see funds that are new to my eyes doing some seriously heavy lifting. Bilador, L1, Westars, and Mirabuka, Argo, Amsel, Sandon, they've each added close to 15% per annum or more of pure alpha for their investors after fees. This is the type of alpha investors in the rest of the world pay big money for. Like I said, I don't know these managers at all, but hey, this is an open invitation. If any are willing to chat, hit me up in the comments below or reach out, and I'd be happy to try to understand better how exactly this outperformance was achieved and report on it here, if they'll let me. Just judging by their factor profiles, Bilador appears to be an EM credit specialist. L1 is a levered contrarian stock picker. Westaz is an EM equity and credit specialist. And Mirabuka is a long-biased Aussie stock picker. But what do I know? Hopefully, I'll be able to meet these folks at some point and get closer to the truth. It would be my pleasure. And that's all from me this week. If you found this content interesting and or useful, please like, comment, share, and subscribe to the channel. It is very much appreciated. And remember, use your money managers. Don't let them use you. Thanks.